Hello and welcome to Chapter 1 of our text. We are going to be looking at many different types of issues and concerns regarding corporate finance, and then figuring out how to do some analysis and how to use the tools that are used in every business in order to make better decisions and to analyze the good points, the strengths, and the bad points or the weaknesses, the flaws in the organization so that greater productivity can be done. Now, this is corporate finance, and that is a continued study of the capital use. Here we see economics taking a big picture of the ocean that the ship is sailing in. Accounting is looking at the specific tools, the numbers that are flowing through for these statements. And we'll get into that a little bit further in the course. So, earlier, accounting and finance just dealt with the main core topics that had to be covered. But later, after World War II, they became much more sophisticated in the tools as we became a much more global environment. So we see that after the 50s, finance began to look at more mergers and acquisitions, the protection of dividend policy, and that meant we needed to know much more about the strength of cash flow for businesses. And that's what we're going to be looking at in further chapters. The focus now is on risk-return relationships, meaning that we get the highest amount of return for a given amount of risk. We want to maximize or optimize our returns, and also to know that all of the parts of the capital structure are working together to strengthen the corporation and to protect the shareholders. These are the effects of financial managers that they have to understand during decision making, understand inflation, sometimes disinflation, and the required rates of return for capital budgeting decisions. We'll talk about that quite a bit, and that's a very important tool to know. These three things are especially important and significant to financial managers. We need to understand the effects of inflation over time, and that also leads to the required rates of return for the cost of capital, which we have some specific formulas that we'll be looking at in further chapters yet to come. There is a lot of background. Many changes had to be made because of the mortgage problems and also the Enron issues. We'll talk a little bit later about how that has affected finance today and made a lot of regulation involved. Also some good things like the internet and some direct to consumer and direct to business, B2C, B2B, which we see has changed not just the way that people buy and sell, but also how money flows. Much different than it was even 10 years ago. E-commerce impacts it because it affects the speed. We collect money faster, and also we're expected to pay our suppliers much faster. So those tools have some good side and some bad side, and we have to respond with that in mind. Financial management is concerned with managing an entity's money. That means the money that has been part of earnings as well as cash that's already been received, and that they are correctly allocated to the capital structure. We'll be talking about that in further chapters. This is just an introductory portion. Here in this chart, we're showing that finance has many different functions. We see that each day and in a period that we are making decisions. As you can see, you can stop and look at this more slowly. But we're looking at the difference between profitability and the risk that it takes to make the profit. Risk return influences both the operations and the financials, especially on debt. How much debt or leverage is the corporation taking on? Different forms of organization, which you've heard of, but we're going to define a little bit better. Sole proprietorship, partnership, and corporation. Sole proprietorship, usually just one person or a family. A partnership are people who are combining their capital and their expertise in the corporation, where you have shareholders, public and private, in order to make the corporation work. The advantages are that it's simpler, it can be simpler, and that there is lower cost for that simplicity, but also there's unlimited liability to the owner, meaning their private investments, their private property can be drawn into potential liabilities of the corporation. Similar in sole proprietorships, there are two or more owners. A little bit more complex, but also the same disadvantage is that the private property of the owners can be considered at risk, or it can be addressed a lien. In a limited partnership, there is a difference in the liability. Some have limited and some have unlimited liability. Also, it provides the ability for those who are just putting capital in to a business to be separated from those who are actually doing management in the business. In a corporation, this is unique. We create an artificial entity, and the owners are shareholders. They put in their capital, and then they often are hiring managers to manage the business. It has a continual life, and it has limited liability, very important to the success of the long-term organization. Also, the disadvantages mentioned here on the slide is that there's a double taxation of earnings. For the corporation pays tax, and then the shareholders will pay tax, particularly on their dividends is what it's referring to. We are seeing here in the subchapter S, income is taxed as direct income to stockholders, and this is almost like a different version of a sole proprietorship. All of the rules that we're talking about, they're put into the FASB, Federal Accounting Standards Board, sets up all the rules, and GAAP, GAAP, is part of that organization that is the Bible for accountants. The primary goal is the maximization of profit, or I would say the optimization of profit. A change in profit may also be a change in risk, but there may be timing in that. Sometimes you get paid early, sometimes you get paid late. The only way to retain power in the long run, or wealth, is by becoming sensitive to shareholder concerns. Those are the owners. So how are they getting paid? By dividends or by capital appreciation? Are there sufficient stock option incentives for the employees and the executives? These are important points to remember. The ultimate measure is how the earnings are valued by the investor. Is it a growth fund? Is it a value fund? The investor has to consider all of the risks and the time pattern in which they're going to get paid. If they are getting dividends, quality and reliability, is that changing? All of these are important to the investors. So you have to have policies that are going to make sure that the market value is correctly assumed, that you are providing employment and some benefits to society. However, the managers need to appreciate all of the benefits of the organization, internal and external. Insider trading is an illegal and unethical practice. This is something which means that information that the public does not know has been leaked for personal profit. This will always, when you're convicted, send you to jail. Financial markets are indicators of the shareholder value. They're not exact, and the market can be wrong for a short period of time. Over time, though, earnings should match the changes in the market price of the securities, assuming it's publicly traded. So the distinct parts of financial markets are domestics, like the New York Stock Exchange, the American Stock Exchange, NASDAQ. The London Exchange would be an international market. Then there are corporate and government markets, where they're trading directly on specific securities, and then money and capital markets, which are more private. Money markets are short-term securities, so we're looking at preservation of capital in this environment, very low interest rates, and these are commercial paper, meaning that they are very short-term in order to cover the liquidity needs of organizations that just need to earn money for a short period of time. Capital markets deals with securities that have a life of more than 1 year. That doesn't mean you have to hold them for 1 year, but these would be stocks and bonds and real estate investment trusts and many other different types of securities. So those can be traded anytime that the market is open. The primary market is when a corporation uses the financial markets to, like during an IPO, initial public offering. And that's pretty difficult. Those are the big players get involved there. But the secondary market is the retail and institutional. That's where you and I can buy and sell stocks and bonds any day the stock market is open, like the Dow Jones and the S&P 500. Each investor then chooses their own risk level, whether they're conservative, moderate, or aggressive, and that depends on their time frame and their target, their goals for why they're saving or investing this money. Companies that are rewarded with high-priced securities can raise new funds, and then they get new capital that they can reinvest. A restructuring changes the capital structure. We see liabilities or debt on the balance sheet together with equities is that we can increase or decrease the amount of debt so that we are changing the balance and the amount of risk that our corporation is taking on. The allocation of capital and a search for lower cost sources of financing is always going on, and you get the lower cost if you have higher quality. In other words, lower risk that you will not renege on your investors or your lenders. So capital markets are looking at cost reduction. They're looking at making sure that they're communicating on a reasonable and periodic basis their plans, and they are growing their markets appropriately.